Hello and welcome to my continuing discussion on deferred tax concepts. In this example, I would like to look at a deferred tax liability again. Got a nice new cartridge in, riding smooth. And this deferred tax liability is going to cover a period of 4 years, because I want to have you see a deferred tax amount come into being, grow, start to reverse out, and then completely reverse out. I'm going to show you this example in such a way that really highlights the calculations. It's a format that's used in the current textbook we're studying in. This is Spice on Intermediate Accounting textbook. Deferred taxes and balances could be calculated easier than this, but the way I'm going to show this really draws attention to what's happening. So it's a bit lengthier than it needs to be. We'll get down to some tidy shortcuts later. So let me write down some facts. The table I'm building, I'm putting down the information for 4 years, and then I'm going to tell the depreciation so you can see that it was the same both on the income statement and the tax return. So first I listed pre-tax accounting income, and I'm going to assume that out of that was taken straight line depreciation expense. Depreciation relates to property, plant, and equipment. That's an asset. This must be a deferred tax liability problem. And in the total life of this asset, going to write off $80 worth. Depreciation taken on the tax return wasn't straight line, it was makers. In the first year it was 25, in the second year it was 33, the third year it was 15, and in the fourth year it was 7. So depreciation expense on the income statement was already taken out of pre-tax accounting income. So in my first year, the 330, I'm going to add back the amount I took out on the income statement for GAAP, and I'm going to subtract what I took on my tax return. So I'm undoing the effect of what I did generally accepted accounting principle-wise and turning it to a tax basis. But if you add up the 25, the 33, and the 15, and the 7, you'll see depreciation expense still totals 80. That is, in fact, how much you get. So my taxable income will be $325 in the first year, $337 in the second year, $370 in the third year, and $413 in the fourth year. And again, I added back the amount of depreciation I took when I calculated my pre-tax income to get rid of the effect, and then I subtracted out the tax return maker's depreciation. What is the difference between those two depreciation methods? Well, 20 minus 25, the difference is 5. I took 5 extra on my tax return in 2013. 20 to 13, I took 13 extra on that year. 20 versus 15, I took 5 less in 2015, and in 2016 I took 13 less. If you do the math on that, a negative 5, a negative 13, positive 5, a positive 13, there is no difference. So you could truly say we know that it's going to be a temporary difference. It reverses out. Since we're talking about property, plant, and equipment, an asset, we're going to be working with a deferred tax liability. Let's get going on our calculations. Remember, I'm going to take a roundabout way to show you this to make sure you understand the nuances of it. We'll get quicker as we go, doing it a slightly different way. The first step in all calculations of journal entries to record taxes is to do reconciliation of accounting income to tax income. So in 2013, we need to do a reconciliation. And again, I'm going to do this in the way that's shown in your books to help you understand that, because I don't think it's all that intuitive right off. We're going to look at 2013 and our pre-tax accounting income in that year. And that's pre-tax. Guess I should write that. Was $330. Then I'm going to say that $20,000 of depreciation was taken out of that, but I need to take another $5 out of that to get to the tax amount, the difference between the 20 and 25. So there's the depreciation expense difference for this year, leaving me with taxable income of $325. And I'm going to list out how this difference is going to originate at 5, grow with 13, start to reverse out with 5, and finish reversing out with 13. As part of the way the author demonstrates this to you in his examples. Let's assume that we have a 40% tax rate. So let's go ahead and calculate that. Our rate is 40%, and 325 times 40% will be 130. Now this is the amount that's going to be future taxable. In 2014, this will reverse. In 2015, or this will grow. 2015 reverse. 2016 finish reversing. This then is our future taxable scenario, is these years. And it's these years that I have in brackets we're going to count. You have a negative 13, a positive 5, and a positive 13. We'll start by making our schedule. We're on 2015 now, and we're starting our reconciliation, and you should never start an entry on this until you have taken pre-tax accounting income and reconciled it to taxable income. And I happen to know from our example that we're only working with one difference, a depreciation expense relating to assets, working with a liability. And we're doing 2015, but we had 2013 going, 2014 going, 2015 going, and 2016, and then a total over here that we're keeping track of. Our current year we're working on is 2015. And you'll recall in our first year, our tax difference was a negative 5 more in the tax return than the income statement. Then it was 13. And then we said 5 was going to reverse out, and then 13 was going to reverse out in 2016. If you're wondering where I got that information, it was back here from the facts, where I had my differences laid out, and then I even summarized them. 5, 13, 5 and 13. Looks like I got to reverse my 5 and 13 over here. Oh, nope, they're good. 5 and 13 and 5 and 13. Very good. And our taxable income we had for 2015, or our accounting income, was $365. And now it's going the other direction, so we have to add it back in as it reverses out. So our taxable income is $370. Our future taxable items only has 1 year left in it, and it totals only that 13. Now we're ready to hit things with our tax rates. Tax rate is still 40% on both of these. 370 times 40% equals 148 taxes payable for our current year, and the $13 we have left in our future taxable items at 40%. is equal to 5.2. That is our desired ending balance. And if you'll recall, we left it at 7.2. So that was our beginning balance. We need to make an entry then for the difference. I need to bring it down by 2. So there's our entry as a tax expense, which will be shown on our income statement, as a taxes payable, which will be shown on our tax return and literally paid. And now we have a deferred tax liability starting to reverse. See, it didn't become a deferred tax asset, it's just reversing. Taxes payable 148. The amount that we're going to reverse is we're going to drop it by 2. And so our tax expense will be 148 plus 2, or minus 2. Don't go plussing on me now, huh? 146. 146 plus 2 is 8. And let's see if that ties to our accounting income. I think if you took 365 times 40%, it's still working. Don't get used to that, but it's okay to check and get a little comfort for now. So, let's look at our deferred tax liability account again. If you'll recall, our deferred tax liability started at 2, then we grew it by 5.2, so it was 7.2, and now we have shrunk it by 2, so 7.2 minus 2 is we're down to 5.2, and that was our desired ending balance. We're in good shape. Just one more year to go to see this completely work its way out. 2016, our reconciliation. We'll start with pre-tax accounting income. Adjust it for that depreciation expense, which is now reversing out, to compute taxable income. We have several years we've been working with. 2013, 2014, 2015, 2016, and a total of future taxable items. And we don't have any more periods that are going to reverse out, because now we're in 2016. It's our last year. Let's grab our numbers. If you'll recall, our income for 2016 was 400, and our tax difference was 13. So income 400, and this time our tax difference is 13, and we are adding that in because now it's less on our tax return. Makers is like that. More up front, less at the end. And there is no future tax item out there. Well, looks like I have everything one line up, don't I? That's okay. Accounting income's right there. Depreciation expenses right there. Taxable income's right there. And we'll squeeze in our rate right here. So cute of me. 40% here, 40% here. 413 times 40% is 165.2. Go ahead and try it. 40% of nothing is nothing. That's the amount then that we need to put as our current tax payable, and it is our current tax expense. And our deferred will be 0. That is our desired ending balance. Where did we leave it? Our beginning balance was 5.2, if you recall from right here. So to zero that out, my entry needs to get rid of another 5.2. That's what we need to do. So we'll have tax expense, which we'll calculate after we find out what happened to the deferred tax liability, and taxes payable. That's what the asset liability approach has us do. 165.2 on our deferred taxes payable, our current portion going to our tax return. 5.2 reversing out, and 160 being the net of the two for our current tax expense. If you take 400, our current tax accounting income, at 40%, you'll see it does tie to the 160. And our taxes payable definitely ties. We got that from our worksheet. Now, this was a long way about it, but you saw our tax expense coming. We're going to have to write up a little here, sorry. Of 5 come into being, grow, reverse up, and end up going away. So in doing it this way, you have a clear example of how it came into being and how we accrued for it, then how we diminished it, and then how we took it away, showing each year as we progressed. Finally, you can say you saw the whole thing on our deferred tax liability account. Our deferred tax liability started with 2, grew by 5.2, went down by 2, went down by 5.2, and ended up with 0. A true temporary difference. It comes into being and goes away. Sorry that took so long, but heck, we did it for years. Hey, thanks for joining me. Bye now.